Canadian investors looking for a high monthly dividend should pay close attention to this video. I'll be breaking down and recommending an ETF that pays in a monthly dividend with an annual yield of around 12%. Before we get started, I'd just like to point you to my very first course. As of May 1st, I'll be launching Canadian Finance Pro. It is my very first course, and I consider it the most in-depth and comprehensive Canadian personal finance course available. I'll be breaking down certain topics like credit, budgeting. I'll go deeper into tax, deeper into investing and the stock market. I know I talk about that on my YouTube channel, but I still get hundreds of questions that people aren't clear about, or they need, like right now I'm at 200 videos and it's hard to follow from beginning to end. So I put it all in one place. It currently has over 60 videos, 7 hours of content as of launch. If you're interested, I'll leave a link to the website. This is the cheapest you'll ever get it. Right now it is $297, but if you use my discount code 50 off from now until May 1st, you'll get 50% off. This is the cheapest you'll ever find the course. As I add more content, it'll only increase from here. Jumping right into the video, I'll be recommending QYLD, keeping with the same theme as last week's video. It is another covered call ETF. I'm looking for high premium during volatile markets, which is what I think we'll be entering in 2022, maybe even in 2023 if we do hit a recession. So I'll briefly talk about what is the NASDAQ 100. So QYLD sells covered calls on the NASDAQ 100. I'll tell you where to invest in it, where to invest in, and then we'll kind of break down who I think it's perfect for. I do an agenda because I ramble, because I can't think off the top of my head. I tend to be all over the place. So what is the NASDAQ 100 index? They sell covered calls on this index. The NASDAQ 100 index is the largest 100 non-financial companies on the NASDAQ exchange. So you'll be dealing with, I believe 50% of these 100 are tech, and then followed by consumer discretionary, then healthcare, and then real estate. If you're wondering why I'm recommending this instead of something that sells on the S&P 500, the NASDAQ 100 index from 2011 to 2020, the returns were 17%. For the S&P 500, the same time period, the returns were 10%. So it is, during a bull run, you will experience more gains, but during a bear market or rising interest rates, there will be more volatility. And that's where I think covered call strategy comes into play. Let's quickly go to the website. QYLD. High income potential. Reasons to consider QYLD. They seek to generate income through covered call writing, which historically produces higher yields in periods of volatility, which is now. They do monthly dividends. They have made monthly distributions for 8 years straight. So it's not technically a dividend from the earnings of a company. They sell covered calls, and that premium they get, they'll do a distribution. So it is easy to mix up distribution and dividend. For the purposes of this video, let's just consider them as the same. If we go down, since this is actively managed, they do have a high expense ratio. Let me zoom in. They have a high expense ratio of 0.6%. So if you have $10,000 invested, $60 would pretty much go to the fund manager. But again, the expense ratio comes out of the fund. It doesn't come out of your pocket. It just indirectly comes out of your returns. If we go into it, now this is in US dollars. I wish I mentioned that at the beginning of this video. So it is around 1997 US dollars, 1990 US dollars. And the distribution is currently 12.31%, which is huge. Now, if we take a look at the distribution history, because it's not a dividend and they make money off of selling premium, it varies. So I did like a GL, like a little dump of their last few years. In 2019, they had a dividend distribution of $2.32, which if we consider the $20 stock price is 11.6%. And then you notice how every month it's different. So if you use this as your main source of income, it is good, but your income will vary widely. The next year, assuming the same $20, the distributions were 12.72, so it's gone up. In 2021, even higher, 14.25, but 2021 was an anomaly year where everything went up. Even the S&P 500 was up, I believe 25 or even 30%. Now I've annualized the first 4 months. So I did these divided by 4 times 12, just to give myself what I think if they continued on this track, it'll be 12.3%, which kind of matches what we have here, 12.31, which is huge. This is great for income investors, but I kind of want to break down the downsides of the covered call strategy. What I realized from my last video on TXF, I mentioned if you just held the underlyings and you sold monthly or quarterly a specific amount, you will end up in a better position. You will end up with more money. But a lot of people said they just don't want to do that. They want something passive. They don't want to think about it. They're not interested in the capital appreciation. They just want the monthly or quarterly distributions or dividends. So it is a different type of investor. If you're looking for growth, I would invest in QQQ. This is the underlying. If you were looking for income, then you would go QYLD, which provides something monthly. Now, if we look at, let's talk about why I'm recommending this now during a period of volatility. Like I think the market would get more crazy from here. It's been just like a giant roller coaster. So since January 1st, 2022, if you invested in QYLD, you would have been down 10.72%, which is pretty upsetting, but you still have that monthly dividend. So it's not the end of the world if you don't have to sell your investment. If you invested in QQQ, you'd be down 18.99%. So you'd be down a little more, a lot more, pretty much, off of your investment in QYLD. So it does make slightly more money during a bear market or periods of volatility. But if we look at something longer term, let's look at 5 years. The last 5 years have been good. It's been like a bull market. So QQQ has gone up 139%. But then QYLD has actually gone down 15%. So you'll do well in periods of volatility, which is now, but over the long term, if we're in a bull run, you will be missing out on the capital appreciation. But then again, everyone keeps mentioning, I'm not investing in this for capital appreciation. I just want the monthly income. I need to live off of it, which is perfect. That's fine. Next on the agenda, TFSA or RSP or taxable account. My recommendation is TFSA. So because this pays US dividends or distributions, the US withholds 15% of the dividend. So if you got $100, you'd own $100 dividend, you'd only get 85 because the US would take their 15. If you invested in QYLD in your RSP, this is a registered account. This is not subject to the 15% withholding tax. You'll get that back, which is great. But when you do end up withdrawing from your RSP, because you want to live off of it, you will end up paying tax. So it kind of defeats the purpose. You save the 15% withholding tax, but when you withdraw to live off of it, you'll pay income tax, which is not the best. That's why I recommend, ideally in your TFSA, you will lose that 15% withholding tax, but over the long term, and if you're living off of it, the income tax saved, I think would be better in the TFSA. So obviously I would do TFSA first, then RSP, then a taxable account. Now it has a very high yield. It is perfect for retirees or anyone living off the higher yield. It's not for anyone looking for overall accumulation. Like I mentioned, if you want overall accumulation, you'd go the S&P 500 or QQQ. So if you're a young Canadian and you're just looking to build your portfolio, I just don't recommend this for you. It will typically underperform during a bull run, which is what I showed you in the last 5 years. And it should outperform during a bear market, which is what I showed you with just the year to date. So I do think we have entered a bear market and we might even enter a recession, which is kind of scary. Covered call ETFs, your overall return is lower over the long term, but you still have your investment and you'd be living off of it. Now, there is some nuance when it comes to the distributions. A lot of their distributions are return of capital, meaning they're pretty much giving you back the money you've invested. So there might not be a tax hit directly. So if we look at the most recent distribution in March, QYLD has distributed more than its income and realized gains. A portion of your distribution may be return of capital. So here they've distributed around 11% return of capital. So it reduces your cost base. If you ever end up selling in a taxable account, this would affect you. This is kind of a big deal. Your tax when you do end up selling would be bigger. Your tax when you earn the dividends will be less because this is considered return of your own money. In your TFSA, this is a non-issue. You can ignore all this noise. If you go into their website, maybe I'll leave a link for this. If you're interested in wondering what a covered call strategy is, I break this down on my channel a lot. I feel myself trading options a lot, so I'm not going to spend time, but they have a really nice infographic that breaks down the entire process of the covered call strategy in case you're interested. So if I want to keep this relatively short, I don't know how long I've been going. Do I recommend this? Yes. Ooh, let's go down some of their holdings. If you're wondering what you would be holding, what they'd be selling covered calls on, it is pretty much the largest companies in the US: Apple, Microsoft, Amazon, Tesla. You probably recognize a bunch of these names. I'm trying to see if there's anything important I want to show. QYLD, you'd be losing 15% over the last 5 years, but 1 year of distributions would kind of bring you back to even, and then everything else should be pure profit. I do recommend this for retirees or people who need to live off the income. If you're young and you're looking for just capital appreciation in general, I do recommend QQQ instead. I know dividends are popular with Canadians and on YouTube pretty much. These are my most successful videos, and people keep asking me to break down more dividends and more covered call ETFs. So I try to give my opinion. Would I invest in this? No, mainly because I do my own covered call strategy and I can earn a little more, but it's great for everyone who's not as active in the market as I am. I'm going to leave it here. Thanks for watching. If you're interested, just check out the website, check out my Canadian Finance Pro. I'll be launching on May 1st. This is the cheapest you'll ever get it. The discount code is 50 off and it expires May 2nd. Thanks for watching and tune into the next one.